Welcome to This Week in Impact, where ImpactAlpha editor David Bank and I break down some of the most interesting impact investing stories of the week. I'm Brian Walsh. It's Thursday, May 2nd. Today we'll discuss the state of blended finance, how big tech can restore both force and credibility in voluntary carbon markets, and why a California foundation has put a diversity, equity, and inclusion lens on 100% of its $1 billion endowment. That's all coming up on This Week in Impact. Hi, David. Another busy week here at ImpactAlpha. How are you doing?
Well, they're all busy weeks, as you know, Brian. We've been sending folks here and there. We've got Rudy Sonatis in Philadelphia at the Total Impact Summit. We've been a mainstay there for many years. And Amy Cortez is headed up to Vermont for a fascinating gathering called the Beyond Bretton Woods Conference, Finance for a Regenerative Future. I think the original Bretton Woods is in New Hampshire, though, but they're next door in Vermont.
All right, well, that sounds good. Excited about those reports. But to start us off this week, Convergence is out with their annual State of Blended Finance report, as Amy Cortez reported for us. Now, a quick reminder, blended finance is when governments or philanthropists provide catalytic capital. That's things like concessional debt and equity, guarantees, credit enhancements, design stage grants, and technical assistance in a deal structure in order to attract larger pools of more purely commercial capital that otherwise wouldn't be interested in the investments. Blended finance is often referred to as the key tool to accelerate the climate transition and meet sustainable development goals. So, David, what did we learn about the status of the blended finance market?
Well, Brian, as you say, blended finance is the key element of meeting the sustainable development goals. We've been all over it as what we call catalytic capital. They're sort of adjacent categories, as it were. The blended finance really takes in more of the development finance and multilateral banks and those kind of players. And it had been sort of the, maybe the dog that didn't bark or something, like such an obvious and high leverage play for those guys, but that hadn't really taken off in recent years and had been lagged behind, people's expectations and hopes. Now, this year, or rather in 2023, it did rebound, and interestingly, higher dollar numbers, $15 billion in 2023, as you said, a 5-year high, lower deal numbers, so fewer bigger deals. And that's kind of the trend that the Convergence report was calling out.
And what do we take from that? These fewer but larger blended finance transactions. Is that saying that there's a return to scale here?
I think so, and certainly sort of transaction costs and whatnot, but also that's that institutional investors, as we've said many times in ImpactAlpha and on the show, have to write checks of a certain size. So they don't really get interested until the deals get big enough for it to be worth their while. The one that we've talked about as well, but that is the sort of signature deal, was this $1 billion SDG loan fund that was crafted last year. And it was interesting because it wasn't just capital catalyzing other capital, but it was 3 levels. And so there was a $25 million tranche from MacArthur Foundation that backed up $111 million from the Dutch DFI called FMO. And then that in turn brought in $1 billion from the German insurer Allianz and Scandia as well. And so it was really showing how you can stack up these layers to sort of take care of everybody's risk appetites and make it all work. I will say there's something a little bit that people should note, which is essentially these are subsidies. These are, if you reduce the risk, you're essentially subsidizing the investment. And, it's to get these large pools of capital, these institutional investors, to essentially do what they should be doing in any event, particularly around, as you said, meeting the sustainable development goals or tackling climate challenges. So it's a little unseemly for both the philanthropic and the kind of public, quasi-public sectors to have to subsidize private capital to get in, but that's the world we're in.
Well, and one of the classic kind of arguments against blended finance is that it's distorting the markets. But I think that those who are supportive of this model say that's the only way we're going to get to scale. And it's subsidizing these commercial private capital providers and kind of subsidizing their own ability to generate profits and alpha, but they wouldn't have been interested in these deals without those subsidies, because there's the perception that the risks are too high in the geographies or the sectors that blended finance is trying to target.
Exactly, and that's obviously the trick, which is the demonstration projects, which create a track record and then folks can assess the real risks, both of markets, as you said, and not generally speaking of technology, because that most of these projects are well beyond, but they are development projects that might be in places with kind of country risk or other kinds of factors. And as you mentioned, climate infrastructure is becoming a big category of blended finance, and that's what and folks do want to bring projects, particularly to emerging markets, developing world, that has been crying out for investment in renewables and things, to but not just for climate reasons, but for energy security reasons. And so there is kind of a notion that blended finance is an idea whose time has come, because now the need and the kinds of project pipeline is there, and the expertise that folks have developed in building these kinds of relatively complex structures is now coming to bear.
Well, as Amy reported, that climate finance accounted for some 80% of all blended finance capital in 2023. So that's showing that this is a tool that maybe is best suited to certain types of investments.
The other thing that's going on is there's a whole push on that's been gathering steam for sort of reforming the development finance world and the multilateral banks. And so the World Bank, at its recent meetings, kicked up or increased its commitment to do these kinds of guarantees. The Inter-American Development Bank has some interesting new strategies and policies. FMO was that we mentioned, and I think the Danish Development Bank as well are seen as kind of leaders in some of this. So as the kind of push on for all of these kind of entities to be more catalytic and to take more risks themselves, one of the ways they can do it is to provide some risk mitigation for others and bring in private capital, thereby expanding their own reach, and that's kind of what the policymaker types and the ministers and the folks interested in the development outcomes are pushing them to do. So there's sort of a set of tools, and all of a sudden they're being pushed to do stuff, and they're reaching for those tools.
Right, and I think that the big knock on these development finance agencies is that their goal or ambition or stated purpose is essentially to crowd in commercial private capital, and the knock against them is that they sometimes too often crowd out commercial private capital because they have this dual mandate to kind of advanced impact or development goals, while also making sure that they don't lose money for their shareholders, which are governments ultimately.
Well, there's that. Another way to say it is sometimes these folks, might or should have been catalytic, and in fact, they were catalyzed themselves. They are operating more like commercial investors and less like catalytic investors. So they take their share of criticism. There do seem to be some green shoots, as we wrote a couple of weeks ago, of reforms and new approaches that they're starting to adapt. So we'll be on that story.
All right. Well, we'll look forward to continuing to cover this space as it's such a big driver of the overall Sustainable Development Goals. But for now, let's take a quick break. When we come back, we'll discuss how big tech companies like Apple and Microsoft are aiming to help indigenous land stewards restore forests.
Every day, ImpactAlpha uncovers stories that make a difference to impact investors. I am Zalaima Bibo, Chief Operating Officer at ImpactAlpha, here with a special reminder. Subscribers get the award-winning brief 5 days a week and so much more. Unlock exclusive coverage, get access to subscriber-only calls and Slack channels, plus search hundreds of jobs and internships at the ImpactAlpha Career Hub. What are you waiting for? Subscribe today. Learn more at impactalpha.com/subscribe.
Deforestation and changes in land use account for about 20% of global greenhouse gas emissions. Mexico-based ImpactAlpha contributor Sean Paul wrote this week about how big tech companies like Apple and Microsoft are aiming to help restore these forests while meeting their long-term climate commitments. Now, David, there's a lot to unpack here, from hard-to-abate corporate emissions, the economics of forest preservation, to the overall veracity of carbon credits. Can you walk us through efforts to bring credibility to the voluntary carbon markets while also supporting indigenous land stewards around the world?
There is a lot to unpack there. The key number to watch really is the price of a ton of carbon on the voluntary carbon markets. And what you'll find if you dig into that is that it's wildly variable. And so the story you mentioned by Sean Paul, who's down there in Michoacan and has been working on kind of forest restoration projects and things like that for many years. This project he describes was getting $10 a ton, and it was all verified and certified and whatnot. And the point he made was that's barely enough to sort of pay for the costs of getting it certified and verified. And so it wasn't really serving as the driver of this kind of restoration efforts, conservation efforts that you could imagine carbon credits might actually support. And so if you again you go back and look on the carbon markets registries, Salesforce has a relatively easy way to check different projects and what the prices are. The best quality ones are getting much more. He also has an example of an outfit that was getting $32 a ton and was sold out of them because they were considered to be higher quality in terms of how long is the carbon going to be stored? Did you actually pull it out of the air versus just avoid emissions by keeping a forest that already existed from being cut down? You don't really quite know what you're really saving, but if you can demonstrate that you've sucked so many tons out of the air, that's considered a higher quality credit. So as the quality of the credits go up, the price of the credits can also go up. And then the other factor in that equation, of course, is demand. And that's what he's talking about in terms of Microsoft and Apple in particular, but other tech companies and some other companies taking a sort of forward-leaning stance to buy up credits for higher prices, and so driving demand up. And there's a lot of effort underway to help increase the corporate demand for carbon credits as a way of raising the price, and again, as I say, making these conservation projects pencil out with the help of carbon credits.
Now, the demand from these companies, this is because they produce and generate greenhouse gas emissions through their operations and through the products they produce and sell. And they have, at the same time, commitments that they've made very publicly to minimize their carbon emissions. And can you talk us through some of the actions that these companies are taking for their hard to abate corporate emissions? What does that mean, hard to abate?
Hard to abate is kind of the euphemism for all the stuff you can't quite get to, or it's too expensive to get to in your own operations. So, in the case of, aviation, for example, sustainable aviation fuel is still a long way off. And so the airlines have to offset their emissions with something else, like save carbon somewhere else for the carbon that they're emitting. So that's what gets counted as hard to abate. Whether the data centers that these tech companies are running, and people should definitely pay attention to the data center issue, because as AI comes to the fore, but also crypto, but even just running a Netflix or a giant e-commerce site like Amazon, the cloud, so to speak, is running on electricity, and these things are becoming an ever larger share of electricity consumption, and it really matters what kind of electricity they're consuming, whether it's coal burning or solar or whatnot. And so they have commitments, and Microsoft has committed to being carbon negative by 2030, and to actually go back and remove all the carbon it has ever emitted since it was founded back in the 1970s by 2050. So they're not sort of going to net zero, but they're sort of trying to set a new bar, which is carbon neutral forever and carbon negative in real time. And Apple has its goals as well. There's a outfit called the Frontier Coalition. It includes Stripe and Alphabet and Shopify and Meta, and they've agreed to spend $1 billion on carbon removal, on tons of carbon removed, put it that way, in the next few years. And they just signed an advance purchase contract, as it were, for $58 million for storage of carbon. So the tech companies are kind of leaning forward in the sense of trying to put forward more ambitious goals, buy advance purchase contracts, and sort of mitigate maybe some of their own reputation issues by being kind of leaders in developing this carbon market.
Well, let's take a quick break there. When we come back, why investment manager diversity matters when investing for equity.
I'm Eric Carmen Gonzalez, ImpactAlpha's Director of Subscription Growth. Ever feel like there's so much happening it's hard to keep up? We hear you. That's why we created ImpactAlpha Latin America, a monthly newsletter for impact investors who want to keep their eye on trends and investments happening in Latin America and the Caribbean. Follow the money and connect with agents of impact powering Latin America's impact economy. Visit our Instagram page @ImpactAlpha and click on the link in our bio to sign up.
In a guest post this week, Rochelle Witharna, the CFO of the California Wellness Foundation, made the case for applying a DEI lens to all aspects of its work, including their decision-making around selecting investment managers. At a time when DEI has become a hot-button political topic, what do you make of a foundation with a $1 billion endowment taking this explicit approach?
Well, Brian, there's something of a kind of race to the top, particularly among these California healthcare foundations. You mentioned California Wellness, and there's another one is California Endowment, which we wrote about several weeks ago, committed to commit its entire $4 billion endowment to be aligned with its mission, including health equity and racial equity. So the foundations, and particularly these California health foundations, which were created when the nonprofit health systems, converted to for-profit a few decades ago, are trying to lean in to this racial equity approach or strategy, at a time when there's been considerable pushback against DEI, both legally and also just sort of rhetorically and politically. And so I think they're trying to sort of stake out that there are folks with some means, some billions, that are doubling down, as it were, and aligning, ever more of their not just numbers, but like their actual processes. So California Wellness made a point about how they select managers, and the kinds of screens they put them through, and that sends a signal to the market of what kind of managers what kind of managers they're looking for. So it becomes a little bit of a virtuous circle and creates kind of a pull and a demand for those kinds of fund managers.
So it's a friendly competition with between these large California-based foundations that have billion-dollar plus endowments. So it's kind of akin to the CalSTRS and CalPERS, the two big pension funds in California that kind of compete on their different investment strategies and approaches. A friendly competition, let's say. So this is Cal Wellness,
or the San Francisco Giants and the LA Dodgers, or the 49ers and the Rams. So California is big enough to have many. But what's interesting too is that these foundations become kind of leaders in the foundation world for adopting new policies, just like, as you mentioned, the pension funds are leaders in the pension fund world. And for example, what was interesting to me about the post that you mentioned is that they would lean so heavily into first-time fund managers. So many of these big endowments, have policies specifically against investing in first-time fund managers because they're considered, unproven or too risky or whatnot. But if you're going to be really making a case for diverse managers with some proximity to the communities and the problems they're trying to solve, and sort of unique insights into all that, you have to go with maybe earlier stage managers and help them get that track record and prove it out. So if Cal Wellness and Cal Endowment and others are really sort of, like we said earlier, changing the investment policies for a little bit of a broader aperture, that could signal to their peers, the same, and that could really open the floodgates for a whole new, generation, a whole new cast of characters in fund management world.
Right. I've always been struck by the catch-22 of the no one willing to take a bet on first-time fund managers, and then how do you get more diverse fund managers then if no one's willing to take a shot on first-time fund managers?
Absolutely. And the additional irony is that there's a lot of evidence, and particularly in the impact world, that first-time fund managers actually outperform. And it's because they're, maybe younger, hungrier, they've been waiting for their moment. They've got the pipeline, the original pipeline stacked up, so they know what they're doing, and they get out there. By the time you've raised your second or third fund, maybe you're off to the golf course or something. But so first-time fund managers arguably, can be more diverse, more inclusive, more
Hungry.
more hungry, more boots on the ground, and do in fact outperform. But as you say, face all these obstacles to getting in the door.
Well, as Rochelle wrote in the piece, though, that she believes it's their fiduciary duty to consider diversity when selecting investment managers, because that's a way of furthering both their financial goals and their overall mission, because they're trying to avoid the groupthink of the kind of modern fund management teams that are largely homogenous and most of them underperform their benchmarks, right?
I love that line about fiduciary duty, because that's a point that gets made, but not often enough, is that if you indeed, and it's true, in these diverse teams also outperform. And so if you have actual evidence and data about an investment approach that outperforms and that meets all kinds of investment criteria and goals, and you're not looking at it, arguably because of implicit or explicit bias, you're violating your fiduciary duty. So it's kind of like saying that the investment world should be just following the data and following the money, and checking their biases at the door, in order to do best for their returns and best for their stakeholders, not for some charity or something, but actually because that is their fiduciary duty, as she says.
Now, Rochelle's piece was part of a series of guest posts leading up to the Mission Investors Exchange conference next week. David, can you tell us a little bit more about that?
Yeah, this, the Mission Investors Exchange is the grouping of foundations that doing impact investing. So it is very much in the sweet spot of ImpactAlpha, and we're the media partner for that conference, which kicks off next week in Los Angeles. And we've had a partnership to elevate guest posts. And so we've had posts from Robert Wood Johnson and from Kellogg Foundation and from Builders Vision, and as you mentioned, Cal Wellness, and we have several more coming up. And we're quite excited about getting down there to LA, and we've got a full agenda down there as well. And I'm moderating a panel on AI and impact, which promises to be exciting.
Yeah, ChatGPT tells me that's going to be a very interesting panel.
It's hallucinating.
All right. Well, look forward to hearing your reports on that in next week's podcast. But that's going to do it for this week in Impact. David, what's the best way for people to contact us with any questions or feedback?
We love that kind of feedback at podcast@impactalpha.com.
All right. Thank you so much, David. And thank you so much to everyone who listened this week. If you liked what you heard, please subscribe to this podcast wherever you listen, and share this podcast with a friend or colleague. If you want to help us out, be sure to rate us and give us a review on Apple Podcasts. It really helps other people find the show. This Week in Impact is a production of ImpactAlpha and part of the ImpactAlpha podcast network, bringing you investment news for a sustainable edge. For more exclusive stories about the world of impact investing and sustainable finance, join other agents of impact by subscribing to ImpactAlpha. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. I'm Brian Walsh. For David Bank, we'll see you next week for more Impact.